In this quick video, I'm going to overview Squarespace, the latest company choosing the direct listing route to go public. Here's an introduction by CNBC.
Squarespace just putting out filing with the SEC for a direct listing. They're going with the New York Stock Exchange. Ticker here is going to be SQSP. This is a software company. Reminder, people use Squarespace to make websites. And by the way, it's profitable going into this direct listing. They reported $30.6 million in net income on about $620 million of revenue last year. Revenue is growing about 28% year over year. So profitable going into this event. The company was last valued at about $10 billion in its last funding round. They had submitted a draft to go public confidentially, but we are getting a couple more details here. Dom, of course, this is the latest company to forego that traditional IPO. We've had a couple direct listings lately. Coinbase, of course, the big one this week. Back to you.
So web hosting firm Squarespace officially filed to go public via a direct listing. The price range is expected to be in the low 60s, so I say we could easily see 70s and up to 80s on opening day. The company reportedly carried a $10 billion valuation in a recent pre-IPO funding round, so that's around what we should be expecting. And just for a little background, Squarespace offers an all-in-one solution for users wanting to create websites, offering domains, hosting, e-commerce solutions, and more. The company competes with Wix and Shopify, which are both public themselves at $16 and $142 billion valuations respectively. Squarespace is going public via a direct listing rather than a traditional initial public offering, so Squarespace won't be hiring underwriters to market the stock. Instead, its pre-IPO shareholders will be selling to make the stock available on the New York Stock Exchange. Like the recent Coinbase and Palantir direct listings before it, Squarespace's listing will help the company avoid standard IPO expenses, maximize returns for pre-IPO investors, while also giving small investors the same chance that large ones get in traditional IPOs to buy into companies at initial prices. As of December 31st, the company has 3.66 million unique subscribers using its platform, but it sees even greater growth potential from small businesses and self-employed ventures worldwide, as well as small and medium-sized firms that aren't even online yet. The company states its near and medium-term addressable market to be in excess of $150 billion, based on its average revenue per unique subscription. And it's worth noting that Squarespace is indeed profitable. The firm wrote in its S1 that its revenues grew from $621.1 million in 2020, up 28.1% from 2019's $484.6 million. That allowed Squarespace to record $60.6 million in 2020 net income, although that's down 47.4% from 2019's $58.2 million of profit. The lower income appears mostly due to a 41.3% boost in 2020 operating expenditures. So is Squarespace a buy? At first glance, I was not interested, but given its modest financial position, incredible brand strength, and choice of direct listing, I believe there could be an easy chance to pick up some shares as the stock falls from insider and early holder selling after it immediately gets publicly listed. For some context, Palantir went from an opening price of $10 and spiked up 13% before falling 10% below its initial price. Coinbase went from an opening of $381 and also spiked up 13% before falling 18% below its initial price. My point is that if you're interested in Squarespace but are not convinced it needs to be part of your portfolio, you might be better served with holding off any market orders and instead going for limits, considering there is likely to be downward pressure inherently as direct listings tend to correct lower before reverting higher. And as I said, Palantir and Coinbase are great examples of that. So what price would you be willing to buy into Squarespace, if at all? It might not seem like a particularly innovative company, but I do think there is something special about its service, having tried it myself and knowing how expensive its offerings are, which is surely to drive increased profitability in the future. What are your thoughts? Until next time.